Wealth Navigation Advisors presents Financial Tides.
Hello, everyone, and welcome to today's Financial Tides episode called Tax Strategies for High Income Earners. I see my background there in case anybody's curious. That's Lake Kolchak in Washington, east of Seattle. It's 7 miles until you get up there, and it's got that beautiful toilet bowl water looking color, as if you put the dye in a toilet. But it's worth the 7 miles if you ever get there. So again, I'm Wealth Navigation Advisors co-owner John Perillo. My partner Taylor Perillo, also a CFP, is with me now, and we're going to discuss some tax strategies for you guys today. So the first one I want to hit on is tax loss harvesting. We did a little bit of this in December. We do it every year. We look at accounts all year for the opportunities. This happens in the non-IRA accounts where we try to sell things that are down in value and then either buy them back in 31 days, and I'll go over that in a second, or buy something else that's similar that we expect to go up in value. So a good example is we buy XYZ auto stock and it goes down, and you're allowed to sell it at a loss. So if you paid $5,000 for that, now it's worth $2,500. You can sell that stock and have a $2,500 loss. You can even buy it back, but you have to wait 31 days. That's why stocks are a little trickier than funds and ETFs, because if just that stock went down, you'd have 31 days of risk there. But what we tend to do is we say, all right, if all auto stocks went down, we sell XYZ and we buy ABC. And then 31 days later, if they went down some more, we can swap back into XYZ again. And that's a swap strategy. So it requires a lot of work on our part, and that's what we do. This is what we do, 40, 50, 60 hours a week.
Yeah, and I think the big point of this is that what we're trying to do is we believe in diversification. Anyone that's ever spoken to us knows that we're huge believers in diversification. So far this year, if you look at the stock markets, I haven't dialed in too much today, but all the US stock market is down, where international is up about 8%. So that gives us the opportunity to say, hey, if we were invested in a fund that mimics the US stock market, let's sell it, buy a different US stock market fund, harvest that loss of whatever the market is down for that individual investor, and now we have some some losses that we can use to offset against some of the gains. So if we said, hey, we have some international stock that we want to sell off, we can sell off that international, harvest that gain, and then do what we call buy low, sell high, and do what's called rebalancing in all the accounts. So that's kind of at the basic level what the tax loss harvest is. But at the higher level, there's something called direct indexing, which is something that we've been using more often lately and having that discussion more often lately. It's a tool that if you're someone that says, hey, I live in a house that I'm trying to sell and it's appreciated so much, especially out here in California, houses are appreciating at a much higher rate than the $500,000 primary residence exclusion. If you said, hey, I'm looking to move in the next 5 years when I retire, we can start doing tax loss harvesting and banking these losses up to help offset some of those gains. So that's just another strategy that we have in the bag where planning comes into play to reduce not only your ordinary income, but have carry over losses for the beyond the $3,000 a year amount for future gains that you know are going to happen at some point in your life.
Good. And so what happens? So if I have $15,000 in losses, can I deduct all of them?
You cannot. So you could only carry forward 3,000 in a given tax year, or you could only write off 3,000 in a given tax year, but you can carry forward the rest into the future. So that's back to that banking the losses. Now, if you can bank 50,000 in losses, and I know everyone, the first thing they're going to say is, well, why would you want to purposefully have losses? And that's not the case with direct indexing. More often than not, there's not just all at 500 companies and the S&P 500 are up. And so if, say, 300 of them are not up and the other 200 of them are, and it causes the entire index to go up because they are market weighted index, we still have 300 stocks to harvest loss from and still have an S&P 500 like return. So you could bank up losses, carry them forward as long as you want while writing off 3,000 against your ordinary income every single year.
I found that amazing when the consultant sat down with us and showed us in all the 20% years for the S&P 500 that over half the stocks were negative. And so there's an opportunity, there. And so set it and forget it is not the opportunity to just buy the index and hold it. It's to find those pockets, and that's a great strategy. The other thing that I think, that pivoting from stock buying and selling is charitable giving. A lot of people, especially wealthy clients, have a desire to give to charity. So there's things, and each of these could be a 2-hour lecture at the university level and still leave questions to be answered. So I'm just going to kind of brush over them. And if it's something you heard about or talked about or want more intel on, we should have a one-on-one. But donor advised funds that allows you to make charitable contributions can be invested and grow tax-free. You can get an immediate tax deduction for your contribution, and then you can distribute to charities over time. There's charitable remainder trusts where you put the money in, you get the deduction, then you get a cash flow from that. Now the money goes to the charity when you're dead. But so you're saying, well, why would I just give my money away? I want to give some to my kids. Now you have cash flow, and this is done with highly appreciated assets, right? So I have a property I paid $50,000 for. It's worth $2 million. That's not me. I'm just saying hypothetically. Now I've got 1.9 million in gains. I can donate this to the charitable remainder trust. They'll start giving me income on 2 million. I have no tax obligation, and I have a tax deduction for the contribution. And over time, I should be able to, if I live long enough, collect at least the 2 million back and get the deduction now and not have to get an $800,000 tax hit. So that's another nice strategy for this super appreciated.
We see a lot of people that are not pooling their donations. So basically they end up using a standard deduction instead of itemizing. They're giving donations over periods of time every single year. And instead of getting the benefit from that because they already took the standard deduction, they're basically losing those tax write-offs. So there's ways to pool them together, and either in the form of a donor advised fund, charitable lead, charitable remainder trust, put those together and take advantage of them all at once in a year that you can use this itemized deduction, and then slowly pay out over time those donations year over year, just like you would normally. So there's definitely things you want to look into on the charitable side that you can use to just not really change everything up too much, but have a little more strategy and a little more planning in the way you're donating.
Yeah, and I think I want to pivot to one of my favorite ones that applies to everybody who is 70 and a half or older, and that's the Qualified Charitable Distribution, or the QCD. This is in place about 8 or 9 years now. The beauty of it is it was started when the required minimum laws were 70 and a half. So now, even though the required minimum is 73 going to 75, they left the QCD at 70 and a half. The QCD means you can take money out of your IRA and have it go directly to the charity, and it's not taxable to you, and it counts towards your required minimum. Now, I just mentioned that you don't have the required minimum at 70 and a half, but if you're somebody who is making contributions to American Red Cross, your neighborhood church or synagogue, any organization out there, you name it, St. Jude's, Shriners, you're giving to these organizations and you're not getting a write-off because you no longer qualify by itemizing. And that happened to a lot of people because the standard deduction now is up to, what is it up to now, Taylor? 29,000?
Yeah.
30,000. So a lot of people are not, as a couple, are not hitting $30,000. Their mortgages are paid off. They've got very little interest. The SALT provision is affecting that. So they wind up with $16,000, $17,000 in itemized, and they have 30,000 in standard. So they take the standard deduction. Now they're taking money out of the IRA, paying tax on it, and dropping it in the bin at church. and they're not getting a tax benefit for that. Instead, why take $100 out of the IRA to net 70 and give 70 to the church? You can just give 90 or $100 straight to the church from the IRA. You don't pay tax on it, and they don't pay tax on it. So if you're making any kind of charitable donations and you're not talking to us about this, please let us know because it's easy. We're really good at setting them up. Once we put them in the system, they're there. So if every year you like to do it at Christmas time or midsummer, you have a certain charity, that charity is going to be there. You let us know when we hit the go button and it comes out of the IRA. So one of my favorites, and I think everybody on this call either has a parent or is already 70 and a half, you can benefit from this.
Yeah, and then I think moving on to the next strategy is just the family wealth planning because right now we're under a tax code where the estate tax limits are very high, but that's not always going to be the case. So there's a lot of nuances with the current tax code and it's sunsetting at the end of this year. So we're going to find out what the new tax code is going to be here pretty soon. But I think it's close to $14 million of estate tax that if you're under that, that's the lifetime exclusion. We expect that to come down just because of how high it is. It's pretty much nowhere to go but down. And it's a negotiating point that it's something that might have to be given up to get other parts of the tax code through. So there's a lot of different things as far as gifting to family members. The first thing is if you give up to $19,000 a year this year to your family members, you don't get any tax write-off, but it shrinks that estate tax burden because your account is now 18,000. So a married couple can do, or 19,000. A married couple can do 19,000 each to every single kid, grandkid, anyone that they want to keep shrinking that estate. So that's in the case of a very large estate. And then we'll keep talking about that with people as that limit comes down. And then the other option is if you're getting a high income and you have an asset that's producing income and you don't need all of that income that you're getting, it makes a lot of sense to start gifting income producing assets, maybe a rental property now, depending on whether or not you want to pay the taxes on it, what your situation individually is because of the step up in basis. But it's a way to get another asset and an income off of your books and off of your tax return and give it to the next generation ahead of time. So that's just a couple of ways of gifting assets and kind of getting things off of your books into the next generation sooner rather than later to help your tax return in the short term.
I pretty much covered everything I wanted to cover. Did you have any questions you want to throw at me?
There's a couple other things. You want to go into the 529 plan and how
Oh, yeah.
529s can help
That's
reduce the
another good
state?
idea because the 529, otherwise called originally the college savings plans, but under a couple administrations ago, they opened it up to cover lower education as well. So it can be used for private high schools, private grammar schools. So the 529 is wonderful. You don't get a tax write-off by putting the money in there, but it grows tax-free or tax deferred, and it comes out tax-free if used for education. So I say it grows tax deferred, meaning that if you pull it out to buy a Mercedes-Benz, it's going to be taxable. But as long as it gets used for education, it's tax-free. And so if you think about the power of that, it's also something you can ping pong around. I set it up for my children, my child, and they wind up going and getting a full ride to Annapolis Naval Academy, and they don't need a dime for it. I just let it keep growing. And then when they have children, I reassign it to their children. Now it's got another generation to grow. So that's a very powerful planning tool for building an immense amount of wealth. And what we like to do is very strategic in how we do it. For grandparents, we like to have the grandparent have it in their name with the grandchild as the beneficiary for schooling, not the parent's name, because when they go to apply for school, if there's a financial aid opportunity, we don't want them to say, hey, the parent's got this asset of $100,000. Thank you, send it in. So two twin brothers, if the one of them had grandma as the owner and the other one had himself as the owner, the twin brother that had himself as the owner, that university is going to say, thank you, send us the check. The other one that has grandma as the owner says, well, you have no assets, so here's your financial aid, here's your bill for out of pocket. Now grandma can authorize money to come out of the 529 to go toward the bill.
Yeah,
So
and I think the big part of the 529 that really helps is you can stack 5 years of gifts all into one single tax year. So you're allowed to do all of your gifts up front for a 529 plan. So that can not just the 19,000, you can do 5 years of the 19,000 all at once into a 529 plan. So it's a good way if you need to reduce your estate tax and shrink your total estate. You could do that all at once, because if you have to do it slowly, that estate's going to keep growing, especially at the size right now where a $14 million estate, even if you take 19,000 out and give it to every single grandkid you have, it's still going to be tough to shrink it just from normal, regular long-term growth. So that's a way that you could do it all at once in the 529 plan, get it out of the estate and get it growing in somebody else's name rather than yours. And
let's
then,
talk about the Roth, Taylor, with the new rules now with the 529 to Roth.
yeah, and well, I'm going to keep the focus on the high income earners side of it. But another benefit, and we've talked about this in other podcasts, is just if you don't use the full amount of the 529, some of it is convertible to a Roth. So we have a whole 529 podcast if you're interested in learning more about that.
Yeah, but since we touched on it, I think for the people who don't want to go find that very quickly, I'm 23 years old and I'm done with everything. I don't need any more education money, and I've got $50,000 in a 529 that I was left that was opened when I was 5 years old. Now I can do my regular annual Roth contribution from there, $7,000 a year of Roth contribution. So 35 can come out and slide over to Roth and be tax-free for the rest of my life. So just another way to, if you don't have the assets to get started early, you're started. So
Yeah, and then there's the family limited partnerships, which this is for the very, very large estates. I don't think there's a whole ton of people listening to this that it's going to apply to. So I'll just touch on it briefly. The beauty of family limited partnerships is that they're valued at a discount typically, so it can reduce the taxable value of your estate. So if you're above that estate tax limit or it comes down, it's something that we'll want to start looking at and exploring with you just because of the discount factor that it can have. And then the last but not least, I'd say almost everybody has real estate. Not everyone has a rental or real estate investment. There's a potential for depreciation, most of them over 27 and a half years. Some accelerated depreciation can happen depending on a cost. It's called a cost segregation study. And it'll allow you to deduct portions of the property's value, and it could offset some of that rental income that you have or other gains and lower your income as well. So it's just another thing that you want to be looking out for if you ever have a property or a real estate investment that you can't depreciate the land on it, but you can depreciate everything else on that as well. So
and my hope is actually that you said there's probably not many people that this applies to, but my hope is that maybe Oprah Winfrey or Clint Eastwood or Warren Buffett is tuned in today and that they're going to give us a call soon.
thank you so much, guys, for listening to Financial Tides. You have a great rest of your day today. We'll catch you next time.
Thank you, guys.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.